Many of you might have heard the term wealth transfer before, but have you ever thought about what it means? The term denotes the gradual transition in finances and demographics, and of the generation born between 1946 to 1964 to prospective generations, encompassing millennials, the term used for people born from 1981 to 1999. This is stimulated through various means, and a lot of things you need to consider and know about wealth transfer to use it to your full advantage. So if you're wondering where to find them, then do not worry, you're in the right place. In today's video, we'll give you all the necessary details all in one place. So watch this video till the end to get everything. Here we begin. You might have heard about the upcoming recession and how it is practically guaranteed, but before seeing why people are so sure about it, let's take a look at what a recession is and the factors it involves. A recession is practically guaranteed. A recession can be explained as a substantial decline in financial activities that persists for several years or even months. Financial experts proclaim a recession when the economic condition of a nation experiences unfavorable GDP or gross domestic product, increasing levels of issues such as unemployment, declining commercial sales, and halting extensive revenue and manufacturing for an extensive duration of time. Recessions are deemed an inevitable aspect of the business cycle or the traditional measure of expansion and condensation that arises in the country's economy. So this brings us to our next question: what causes recessions? Several ways can be responsible for starting a recession, from an abrupt economic impact to an outcome from disorderly inflation. But some factors are the central aspects of causing a recession, and these are technological change. Innovations boost productivity and stimulate frugality over the extended term. Still, there might be short-term adjustment intervals due to major technological breakthroughs happening worldwide. During the 19th century, ripples were caused because of advancements in labor-saving technologies. The famous Industrial Revolution gave rise to the obsoleteness of professions universally, spurring recessions and difficult times. Fast forward to a few decades later, some economists have shown concern about artificial intelligence and robots finding huge prevalence in today's time might result in recessions by abolishing broad categories of jobs. An abrupt economic shock. A monetary shock is an unexpected problem that establishes significant monetary damage. For example, in the 1970s, OPEC increased oil prices twice as much without any indication in India, therefore resulting in a monetary crisis. A very appropriate and recent instance of this factor is the outbreak of coronavirus, which has adversely impacted the economy of countries globally. Excessive debt. When people or businesses take up a lot of debt, the expense of fixing the debt can rise to the level where they cannot even afford to settle their bills, accumulating debt bankruptcies and insolvencies, therefore capsizing the economy as a result. A good example is the lodging drip in the mid-aughts that ultimately steered toward the Great Recession. Business cycles and recessions. The business cycle interprets the manner in which an economy shifts between intervals of proliferation and recessions. As economic proliferation commences, the economy discerns active and sustainable expansion. Over a period of time, moneylenders make it more susceptible and less costly to obtain money, motivating consumers and companies to pile up on debt. As a result, unreasonable exuberance begins to surpass asset prices. As the development of the economy ages, the value of assets rises more promptly and debt pressures become enormous. At a specific level in the business cycle, one of these events derails monetary expansion. As an outcome, development contracts and the county's economy reach the point of recession. Why should you take action now? Signs that there is an upcoming recession. Inflation and supply chain disruptions. The disruptions in the supply chain in Asia and monetary sanctions against the oil and gas from Russia have aggravated the inflation issue in the United States that started in 2021. The Federal Reserve also miscalculated how seriously it was required to perform to restrain inflation. It was recently recorded by the PCE, or Personal Consumption Expenditures, that the price index increased 6.3% year over year in the month of July. While root PCE expansion is down narrowly from elevated levels of 5.3% in February, it still persists to be near highs in the past multi-decade, last seen only in the 1980s. As a result, consumers are suffering the brunt of heightened prices for daily used goods and aids. Fed interest rate hikes. In acknowledgement of dismaying inflation, the federal funds rate has been increased by the Fed substantially this year, encompassing 75 BPS percentage hikes in the months between June, July, and September. Yield curve inversion. Then concerns about a recession increased at the beginning of July, when the profit on 2-year Treasury notes of the United States plummeted above the profits compared to 10-year Treasury notes. This event is called the yield curve inversion. Inverted yield curves have proven to be a powerful indicator of economic recession. Now let's talk about another influential component known as bear markets and how it affects recession. So what do you mean by a bear market? A bear market occurs when a market encounters an extended decline in price. It generally interprets a situation in which the price of securities falls 20% or even more due to contemporary highs amidst widespread dismay and investors' adverse sentiments. Bear markets are often correlated with decreases in an all-around market or inventory, like the S&P 500. Still, personal commodities and securities can also be deemed to be a part of a bear market if they encounter a reduction of 20% or extra over a sustained interval of time, generally around 2 months or even more. How are bear markets and recessions related? It is typically said that even though bear markets and recessions go hand in hand, they are fundamentally diverse issues. As we have explained, the bear market is the outcome of insufficient investor composure in the rise of prospective prices of the stocks. As a matter of fact, an economic recession is a consequence of the failure of consumer and business confidence and curtailed customer spending in the economy. The stock market is a steady introspection of the monetary performance of any nation. If the economy is not prospering, it will certainly impact the markets, and the extended unfavorable market execution can indicate poor monetary health. Let's move on to the Dow Jones now. So what exactly is the Dow Jones? The DJIA, or Dow Jones, which stands for Dow Jones Industrial Average, is an index of the stock market that tracks the stock price trends of thrifty blue-chip, publicly traded companies. What do you mean by millennial millionaires? Undoubtedly, the millennials and Gen Z of this era are encountering some distinct challenges. They aspire to thrive in a period of economic skepticism and rising inequality, but do not make any mistake by thinking they do not know how to deal with it, because they also happen to be a generation that likes to take control of their own future. Starting from spending habits and savings to side businesses or jobs and investing, the young people of today's time are determined to create promising prospects for themselves. And what is pushing this trend? It is steered by various factors, encompassing heightened access to data, capital, and technology. But this was only possible with a shift in mindset. You should also consider market drop. So what is a market drop or stock market crash? A market drop or stock market crash pertains to an intense, frequently unforeseen decline in the rates of stocks or shares in the stock market. The unexpected decrease in the prices of stocks may be affected by catastrophic events, economic conditions, or unpredictable elements that glide across the market. Most market blows are generally short breaks of downturns in the market that can persist for one day or a long time to make heavy losses for investors. A drop in stock or share market happens when the market enters a volatile phase, and a monetary disturbance spurs the price of shares to plummet unexpectedly and abruptly. But what is important is that after a stock market crash, the alarm trading can be deterred by acquiring plunge security or accelerating market-wide circuit breakers. Lastly, following good and reasonable financial habits is vital to protect your financial well-being. You should hence take action now and start following them. That's it for today. We'll be back soon with more amazing videos, so stay tuned. You can drop your queries and suggestions for our next video in the comment section below. And remember to like and share this video if you like our content.